Hey all, my name is Paul Borosky and I am the owner of Quality Business Plan. And what I'd like to do today is to present with y'all a series focused on understanding and explaining pro forma financial projections. So specifically, when I write a business plan for a client in financial pro forma financial projections, I follow a specific structure that is systematic that I've come up with myself that helps the reader understand where the financial projections come from. So in order for y'all to be able to explain your financial projections, you kind of have to need a little bit of insight as to the structure of what I provide. And so that's where this series is coming from, is to help y'all understand your financial projections, how they were come about, some of the calculations involved, and when you are ready to present your business plan with the financial projections, you're going to be able to speak confidently and knowledgeably about your financial, not only it's going to be able to speak knowledgeably about your pro forma financial projections. All right, so with that said, let's dive into the heart of this video. For this part right here, it's going to be part one with your financial assumptions. When I provide clients with their financial projections, the first page is going to look similar to this. It's going to say financial projections. For the most part, it's going to have a financial highlights graph, and then I'm going to have several assumptions for the financial projections. So for the financial projections, this paragraph right here is going to be the highlights, and the highlights of your organization, and the highlights are going to be your first year revenues, it's going to be your first year cost, it's going to be your net profits for the first year, and it's going to be your profit margin for the first year. And then from that, I'm going to go into explaining how your organization is going to grow, focused on the net income, specifically $159,000 and change, and then for 5 years as well. Again, it's going to be $196,313. So these numbers right here are found on your financial model. You will need your financial projections, and if you want to have some insights to it, you'll need your financial model as well. So the financial model will be right here, and the costs that I pull from are going to be in this section. So you're going to go to your projections tab, and you're going to be looking in this section right here. This is a summary of your first 5 years of your revenues, your costs, and your net profits. And these are the numbers I use for your highlights right here for the first paragraph. For your financial highlights, this is just, again, a highlight of the highlights, but in a visual form. To get this information, again, you're going to need your financial model. And on your financial model, you're going to want to go to your projections tab, and it's going to be right here. Your graph is going to be right here, just below your sales growth. And all you do is, if you're going to update your financial projections with the model I provide, then you just copy this right here and plug it in. And these financial highlights, this financial model right here, the purple right here is going to be your revenues. The next column is going to be your cost, and then the third column is going to be your net profits. And I've got a little footnote right here. So the highlights just entices the reader and tells them, look, in a short order, here's how much I'm going to be making, here's my costs, and here are my profits. We throw them a little bit of a bone for the profit margin. And so the profit margin, when we calculate the profit margin, and your profit margin is going to be, again, on the projections tab, it's going to be right here. And all I'm doing for the profit margin is I am taking your net profits and I'm dividing those by your revenues. So it's net profits divided by revenues is going to give us our profit margin, and that's where we're going to find that number right here. All right, so with that said, the next section after I do my highlights is going to be the financial assumptions. So the financial assumptions, all those is we're telling the user of the business plan that based on our projections are based on some assumptions. We need to predict a future, and in order for us to predict a future, we need to have some parameters. We need to state what we're thinking and what our assumptions are going to be based on the financial model. So again, in my business plans, I do have I use the same structure for all my business plans for the financial assumptions. I just change the wording around a little bit, and also the numbers, just to make sure I've got all my bases covered. So for the first bullet point, all financial projections are based on management and owner professional expectations of sales and expenses for the foreseeable future. This bullet point just tells the reader that, look, we don't know what the heck's going to happen tomorrow, let alone next week, next month, or next year. These are our best guesses. So that this sets their expectations that, you know what, we know we're going to be wrong, but at least, we're telling you up front, we know it, and this is our best guess. The next bullet point, for the first 12 months, sales should increase by 2.8% per month. In months 13 to 24, sales should slow to around 0.58% per month. For years 3 through 5, sales are expected to grow between 3 to 3.5% per month. So what does this mean? In the financial model, on the information page, I do provide growth rates. So what we're going to do is we're going to be estimating that our revenues are going to be growing at a certain point, at a certain pace for year 1, 2, 3, 4, and 5. So for year 1, we're saying that we have a growth rate of 25%. So we would go to the profit and loss tab, and we've got a growth rate right here underneath on E43, a growth rate of 2.08%. The way we come about 2.8% is I take that 25%, I divide that by 12, and that's going to give us 2.08%. So that's where I come up with the growth rate of 25%. Now, keep in mind, this is going to be compounded. It's going to be compounded monthly, so the growth rate is actually going to be higher than 25%, but we're going with just a flat annual growth rate divided by 25, just to make it simple. I mean, we can really blow the complications of this model up exponentially, and we really don't need to, because the numbers could be wrong anyways. We just need to give a estimate of where our thinking is. So that's where that's going to come from. For year 2, I'm going to take we're estimating our growth rate is going to be 7%. And so I'm going to play the same game. In profit and loss statement, year 2, I'm going to take that 7% divided by 12, and it's going to be 0.58% monthly. So again, I know compound interest is going to actually grow a lot higher than that, but for simplicity's sake, this is how I structured the model. For month 3 through 5, I just use this growth rate right here. I'll go to the income statement for year 3. I'll be multiplying years 2 revenues by 1 plus the growth rate for year 3, which is going to be 3.5%, year 4, 3%, year 5, 3% as well. So that's where I'm coming up with the numbers, and that's how the model is actually used for the growth rates. And that explains the year 3 to year 5, and I showed you where the growth rates came from there. Cost of goods sold or variable costs are expected to be about 35% of total sales. So where we're getting this information from is going to be the daily sales. And so for the daily sales, the way that I structure this is going to be average customer sales. So for this particular example, we're saying we're going to have 59 customers in our restaurant or our shop on a daily basis. The sales price on average is going to be $35. And our cost, our variable cost is going to be $12.25. And the way that I get this $12.25 is I estimated that we have a variable cost or cost of goods. I do use that term interchangeably. So right here you'll see variable cost, but on our profit and loss statement is going to be cost of goods sold. So I do use the term interchangeably. Please be cognizant of that. All right, so let's see here. So where were we? So we're at the revenues. Revenues are going to be, like I said, 39 people a day, 59 people a day. Price is $35. Variable cost, I'm going to take that 35%, and I'm going to multiply that by the price, and that's going to be our variable cost or our cost of goods sold. So again, keep in mind, terms are used interchangeably here. All right, so that's where we're getting our cost of goods sold from is 35%. Next is going to be the initial advertising budget will be $1,500. And so where we're getting this number from is we're going down to our fixed costs. We got advertising fixed costs, $1,500. This also wraps into our profit and loss statement right here at advertising $1,500 per month. And we've got it going all the way across here. And then also in the income statement, I multiplied that $1,500 by 12 is going to give us our $18,000. And then on an annual basis, it's going to grow based on our growth rates, which our growth rates are right here, and here's our advertising growth rate. So that's what our assumption is going to be, is we're starting that game at $1,500 and we're growing that by 1%. So again, we go to our information page, growth rates, and we see it's 1% growth rate annually. Next thing what we're going to do is we're going to take a look at the cost projections were calculated using a common size financial model. So for the most part, what I mean by a common size financial model is if we go to our profit and loss tab right here, we have our 12-month profit and loss right here, quarter 1, month 1 through month 3. We've got quarter 2, month 4 through month 6, quarter 3, month 7 through month 9, and so on. And what I've done here is here's our common size model. So the way I do my common size model is I divide all of these line items here by revenues. So an example of this would be revenues divided by revenues is 100%. And then I'll take the cost of goods revenues here, right here, divided by itself is going to be 100%. Then the common size for the cost of goods is going to be the 35%. And for 35%, what I'm doing is I'm taking our cost of goods sold and I'm dividing this right here by the revenues. And that tells us it's 35%. I'll do the same thing for the salary. I'll take salary, which is right here. I'll divide that by revenues, and that gives me a percentage of sales for salary is 8%. And so in some of these line items, I'm going to use the percentages down here to grow your costs. So for the first year, we might have a labor of 35.7%. So I'm going to use that 35.7%. I'm going to use that to grow the labor on a continuous basis. So as our organization grows, then the labor costs may grow as well. All right, and then let's see here. The next thing we're going to be looking at is going to be, let's see here, initial advertising budget. So we talked about that. Cost of goods sold, I showed you all what the common size model looks like. Tax rate. I do assume that the tax rate is going to be 20%. If it's a nonprofit organization, I'm going to make this tax rate 0 and I will delete this line. So where we're going to find this in the financial model, we're going to go to information page and we're going to look for miscellaneous information, and our tax rate is right here. We can change this tax rate to whatever we like, and once we change that tax rate to, if we want to change it to 25% or 30%, we can do that there. And then what's going to happen is it's going to change what we're going to be multiplying our EBIT, or our earnings before interest and taxes. We're going to, our EBIT right here, is right here, earnings before interest and taxes. We'll deduct the interest expense, earnings before taxes, EBT. And we're going to get our taxes by multiplying the EBT, or earnings before taxes, by our tax rate. And for this example, again, is 20%. And that's where our taxes are coming from. All right, let's go ahead and move that over. And next is going to be our initial funding. So the initial funding needed is going to be $200,000. An increase or decrease in the amount will impact the net present value and internal rate of return. These are just calculations for our capital budgeting calculations that some of my business plans do have. We get the initial funding for $200,000. We can find that number in a couple places. If we go to our projections tab, initial funding, our $200,000 is right here, and then we can get the number from there. Or we can go to our information tab, and we can go to our startup costs or expansion costs, depending on your situation. And this structure shows the equity investment for this example is $20,000. Loan amount is $180,000. Total is up to $200,000. And then from here, I break that $200,000 out into various budgets, and we sum it up. And again, it's going to be $200,000. So we can get our $200,000 startup cost from right there as well. See here, and the increase and decrease will impact the net present value and internal rate return. That is our capital budgeting, and that would be under the capital budgeting tab. And in the capital budgeting tab, you're going to find your IRR right here. For this example, it is 92.33%. And then our, let's say our valuation will be right here, net present value. is based on, now this is not a retail sales price of the organization. This is just based on the cash flow. So based on the cash flows and the investment, we're saying the net present value is $752,599. So and if we change our initial investment, which is going to be right here, if we change this number, then of course it's going to impact our calculations for the valuation as well as the IRR, because the initial cash flow or the investment is part of the calculations as well. And we can see that by clicking the IRR, and that $200,000 is included. All right, and then the next step is going to be the starting cash balance needed is going to be $29,000 for working capital. Working capital, what that means is once you start your organization, day one, you do need a little bit of money in the bank to keep the lights on and to pay your employees and to buy inventory as it sells out and you're waiting for payments. So you do need a little bit of money in the bank after you start your organization day one, and that money is called working capital. The way we get that number there is we're going to go to the information page, and in the startup costs, we're going to identify working capital. How much money do you want to have in the bank day one when you start your organization? And that number right here in our example is $29,000. We can also get our working capital from right here. $29,000 is going to be on the projections tab. We'll go down to C20, and it's $29,000. So that again is our working capital, and the cash account was used for the balance sheet, used for the balance the assets with the liabilities and equity. So for the balance sheet gets a little bit tricky, and so what I do is I will go ahead and I'll calculate how much your inventories are going to be at the end of the year, your total current assets, your property, plant, and equipment. I'll total up all this information right here. And then what I'll do is I will total up all your accounts payable and everything like that. Your accounts payable, your notes payable, your accruals, total current liabilities, your loans, your total liabilities, your common stock, retained earning. All this information will be calculated. And what I'll do is I will deduct from your total liability and equity, this number right here. I will deduct what your inventory, your property, plant, and equipment is, less depreciation, net property, plant, and equipment. I'll deduct that information, and whatever is left over, I'm going to plug into the cash account. So we'll deduct all this information from the liabilities and the equity, and whatever is left over is going to be considered cash. So that's how the cash is calculated for the balance sheet. All right, so that ends our little introduction for the pro forma. That ends our part one of the financial assumptions. And so, so let's wrap this up. So if y'all have any questions about the financial assumptions, definitely watch this video, and hopefully this was helpful. And if you liked the video, give me a thumbs up. And as always, have a great day. Thank you.